Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, surviving the great shred of 2022. Steps you can take if you were a part of the IRS house cleaning efforts. Today we're going to take a look. Stay tuned for Prudent Money. Listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, supposed to have Dan Pilla on today to talk a little bit about, continue talking about what we introduced last month, which was he calls the Great Shred, where the IRS shredded, I think, over 30 million tax documents just to try to keep up and to get caught up somehow. And what the implications of that are, I'm not getting any messages from the studio, so I would assume that we're all kind of all out of luck with Dan getting on the program. So I'm going to open up the phone lines. If you'd like to call in, 1-877-913-5357. That is the number to call. You can also go to the website at prudentmoney.com. Send a question in, and I will get you taken care of. That's all at the website, prudentmoney.com. 1-877-913-5357. Well, today we started off with a much anticipated report, as you can imagine. The markets are always interested to know what's inflation doing. All they'd have to do is ask me. I could tell them what happens when I go to the grocery store, much like you could. It's going up. The price of food is going up. I was talking to somebody today, and they said they went into they were actually up in the Michigan area, but they went to the grocery store, purchased 5 items, and spent $85. That's a common story. It's a very common story that we're hearing. Frequently, and I know that I've experienced it. I think I've said that the cost, probably overall cost, is somewhere around 20% of an increase. And I'm going to go ahead and give out this. Hold on just a second, Jerry. Let me give you this number. I'm going to go ahead and put it into the system and see if we can get Dan. Well, let's see here. Thank you for bearing with me here as I'm trying to get Dan, get this worked out here. Gotta love live radio. Okay, there we go. And Chris is going to see what he can do to get that taken care of. But anyway, the market was anticipating not really knowing what to participate. I mean, what to anticipate, just because there's always rumors that inflation is topped, but not so much. In fact, it was a little bit hotter than expected. It was up year over year. Last 12 months, it was up a little over 9%. So definitely trending in the wrong direction. But as I've said, it doesn't take a mathematician to look at the increase in groceries, the increase in gas, and the increase in pre-owned cars is another example. Shipping costs, I mean, you name it, and we're looking like 20 to 25% as an average. And that's what I've always had as the probable rise in inflation. So someone was telling me today, as well as another conversation, we were talking about it, and the question was, well, how long could this actually last? And it's hard to tell, but the problem spot with inflation is that we're looking at it taking quite a bit of time to chip away at a 20 to 25% inflation rate, if that is truly what's happening. Because take it from the standpoint of a 9% inflation rate. Well, a 9% inflation rate, if you can at least cut that in half, which you can do over a reasonable period of time. But going from 20 to 25 down to 3 to 4% is a tough deal. So markets didn't react too fondly of that information, but not as bad as could be. The S&P 500 was down about 0.5%. The Dow Jones Industrial Average was a little over 0.5%, and the Nasdaq just barely down. So today does officially start earnings season. We talked about that yesterday, and we'll just kind of have to see how that turns out. Remember, earnings are a very important aspect of the stock market because that determines whether or not, it's just like your report card. You go home with the report card. If it's good and your parents anticipate that it's good, your parents are going to be happy, going to congratulate you, maybe even take you out and buy you a gift or something. If you have bad grades and you take them home and your parents are anticipating good grades and they see that you made some C's and some D's, probably not going to take you out for a gift, probably be pretty upset with you because your grades weren't what they should have been. So same thing with earnings. Wall Street tends to punish companies that the earnings reports weren't very good, and they tend to praise and buy companies that their earnings reports were better than expected. And of course, that has a way of filtering throughout the entire market, because if you get a market leader like, we'll just say Apple or Amazon, and you have a situation where the earnings weren't so good and the outlook for earnings aren't so good, market tends to have a problem with that as a whole. So this should be an interesting earnings season, and we'll see what happens. 1-877-913-5357. As I was saying earlier, we were going to have Dan Pill on the program, and we've been having some technical issues. You can't hear it on your side, but I can hear it on my side. But within those technical issues, we've had some problems connecting here with call-ins, and so fortunately, you should always, 20 years of hosting a radio show has taught me you have a backup material. It took me a little while to find it and talk to you at the same time, but by God's good grace, I got backup material. So let's talk a little bit about the emotional coping strategy we started to talk about last week and didn't get through it. But, how do you deal with bad news in the mailbox? And you know what I'm talking about. If you've seen your investment statements, which you should have everybody listened to me about by this time, have probably gotten their statements, and results weren't so good for the month of June in the market. Results aren't so great this month either, but they definitely weren't very good in the month of June. And so the point being is that you don't want to react in emotion. You don't want to have a situation where you get all upset and then you go and you make an emotional decision. And that's what ends up happening quite a bit oftentimes, is that those decisions are made through the emotional filter. And so we talked about the strategy that I mentioned in one seminar is you go to the mailbox, you get the envelope out, you don't open it, and then you walk in the house, you slide it in a drawer, you close the drawer, and no harm, no foul, right? Well, that's a strategy, not a very good strategy unless you're Johnny Carson and you can stick it up to your forehead and read the results. Not a good strategy, though. So John Bogle, who's been on my program a couple of times, he's the founder of Vanguard Mutual Funds, passed away a couple of years ago, 2 or 3 years ago. But he was a legend on Wall Street and in the investment world in general. And he used to always say during times of crisis, don't look at your statements and don't pay attention to it. It's just all noise. Well, if it's all noise, then what ends up happening is that noise catches up with you and you lose value on your retirement account. So something you want to pay attention to. If you remember, we always talk about the two things that you want to know. How much risk am I taking, and am I comfortable with that amount of risk? And those are the, regardless of where the market is, of course, we tend to not worry too much about risk when the market's going up and doing well, because why make changes, right? But I would suggest even in times of change, even in times of really good times where the market is going up, you still should ask that question, because at some point you may not be happy with that risk level you're taking, and it may be a little too late. So just keep that in mind. 1-877-913-5357. This is Bob Brooks. You are listening to the Prudent Money Radio Show. If you've got a question for me, you could always go to the website at www.prudentmoney.com. We're up against a break. Stick around. I'll be right back.
The Word for Today is excited to announce the new official online home for the ministry of Pastor Chuck Smith and Kay Smith, PastorChuck.org. At PastorChuck.org, you'll have instant access to thousands of hours of verse-by-verse teaching by Pastor Chuck Smith from Genesis through Revelation, and full access to special messages on subjects such as prophecy and much, much more. Also at PastorChuck.org, a full library of great teachings by Kay Smith, and a section where you can read some of Pastor Chuck's books online, all free of charge. So visit the new official online home of the Word for Today and the ministry of Pastor Chuck and Kay Smith, PastorChuck.org.
Hi, this is Kirby Anderson with the Point of View Radio Talk Show. I want to invite you to listen to our program on KDKR from 1 o'clock to 3 o'clock p.m. Monday through Friday. We look at various issues from a biblical perspective. Our topics range from politics and economics to the Bible, theology, and apologetics. We also bring authors and informed experts to the program. We talk about anything that affects your faith, your family, or your freedom. Hope you'll join us every day on Point of View right here on Bible School Radio 91.3.
In 1 Corinthians, Paul reminds us to run the race of life to win the prize. Join me, Dr. Erwin Lutzer, for Running to Win. Be strengthened to finish your race with confidence.
Listen daily, 8 a.m. on Bible School Radio 91.3.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. 1-877-913-5357. That is the number to call, and I do have a line open. So we did a webinar about 3 weeks ago talking about how to make money in a bear market. Just because you're in one doesn't mean you have to lose money, because there's always strategies that you can employ when things are not going up. Clearly, this year, things have not been going up. So it's time, and that's when you break out Plan B. One of the things that I talked about, and this just came out of my own research, because it's a little troubling to me how financial media, pop culture, finance, a lot of the articles that they are publishing And like I said, this is probably, as far as bear markets go, maybe the first time that I've been doing it. I've been in this in the investment business for 30 years that I've ever seen so much printed on how we're in a bear market and what all that means. But the bottom line is the message that you get is that bear markets last roughly a year in time. They lose 28-30% on average. We're over 20%. We're not that far from the bottom. So just don't do anything. Don't make any changes for sure. And one of the things that I spelled out in this webinar, which we're going to be doing a series of webinars. We haven't put the next one on the books. We're working on doing that because I think I want to really jump in and talk about inflation, how to handle your investments during inflation, how to deal with cash flow during inflation, and why inflation is such a huge problem this time around versus the problem that it was in the 70s, but I think it's a lot more complicated today. But one of the things that I came up with is that you have to realize, and I'm not going to go into great detail because it's a little bit tough without visuals. I do have a link to the webinar that I am more than happy to send you if you want to send us a request by either going to prudentmoney.com, go to the Ask Bob section, sending that to us, or going to sending to this email address, info@prudentmoney.com or bob@prudentmoney.com. Even if you're driving, you can remember one of those. So I looked at it from the standpoint of not so much all bear markets, but looked at it from the standpoint that there are 5 different types of declines that you could face at any given time as an investor. And so really it's 5 category of risks that occur. And what I'm concerned with is the start of that decline, where you were, the bottom of that decline, and how long it takes you to get back what you lost. What I found is that, especially with writers who write things for yahoo.com and cnbc.com, that they're republishing letters that they sent to their clients, they're just trying to make everybody look at a different reality, which is, I mean, if you really run the numbers, it's just not true. But once again, it always points back to, hey, you've been through 6 months of this, almost 7, and it's just about over with. So just stick it out. You'll be okay. I don't think it works that easy. What I did was I compared the categories of declines in the market with the hurricane rating scale, which is what most people are familiar with. Category 1 hurricane, of course, is your introductory hurricane, not saying that it can't take lives, not saying it can't be serious, but out of all the different types of hurricanes, the 5, it's definitely the least of the 5. Kind of blows through, blows out. It's a wind more so and a water event. And that's the same thing with a stock market correction, where the market could drop 1 to 20%, lose up to 20% and rebound and turn around. So category 1 is just not that serious of a decline when it comes right down to it. It's a normal type of decline and happens quite often throughout a year's work. Not quite often, but could happen 1 to 2 times, but over an 18-month period or something like that. Category 2, now that ups the game a little bit. A Category 2 hurricane has stronger winds. And the problem with the Category 2 hurricane is that it could, as it gets closer to the coastlines, could turn into a very damaging and menacing Category 3 hurricane. But the Category 2 hurricane is like from a stock market decline standpoint, would be when the market crashes. And the best example of this is what happened during COVID, when the market crashed over about 30 to 40 day period and lost about 36%, and then went straight back up as if we didn't have any problems. And that, to me, is what a true stock market crash is. It's a very specific amount of time. It usually comes and goes pretty fast, but it's scary. It's just like a Category 2 hurricane, kind of comes and goes real fast, but it's still pretty scary. It's pretty scary. Then you have your Category 3 hurricane, which is probably your average, your typical hurricane that comes in as Category 3, does a lot of damage. Cleanup takes a while, and things don't get to normal for year and a half, maybe 2 years. And that's the same thing with the Category 3 decline in the stock market. You get a situation where a lot of damage is done. You can lose up to 50% of your portfolio. No, I'm sorry, not 50%. You can lose up to 30%, 30% of your portfolio. And then things rebound, and it takes a while to get back, but it's not too bad. Maybe you get your losses back in a couple of years. And then there's the Category 4 hurricane, which is a very destructive hurricane, which is a lot like a Category 4 decline, which would be a bear market. Category 3 would be a bear market as well, but Category 3 comes and goes and gets through a lot quicker than a Category 4, where you're looking at about 5 years to get your money back. And a Category 4 decline is very destructive, with losses up to 50%. Then you have Category 5, which is the worst of all hurricanes. I think the wind speed is clocked at about 157 miles per hour. It's very, very destructive. And same thing with the Category 5 stock market decline is very, very destructive. The only one that I would be able to point out is 1929 to 1932, where the Dow Jones Industrial Average lost 86%. I want you to take a step back and think about that for a second. 86% in the period of 1929 to 1932. If you are a history buff, love to read about history, love to read about the markets and history about the markets, there's a great book called When the Bubble Burst. And it's about the 1929 stock market crash, all the various personalities and characters that were involved in it. It was written in the early 70s, and if you went searching for it, you could probably find it. But fascinating book, and you can start to see pretty quick how different that day and that time was versus today's time. Now, a Category 5 decline in the stock market would probably be somewhere between 50 and 70% decline. So it'd be a pretty horrific decline. Now, Pop Culture Finance would tell you that there's absolutely no way that could ever happen again. And there's always a probability. Granted, it is smaller of a probability. So what I'm trying to say is, if you break it down into categories, you can see that this thing can get out of control. It's just not an average bear market like everybody in Pop Culture Finance would have you believe. Could be. It's definitely not a crash. We're way beyond that, Category 2, and it's definitely, I don't think that we're going to discover that this is a Category 1 decline at all. But one of the things that I want to encourage you to get that link to that webinar is because this is something we're going to build off of as a resource for prudentmoney.com, and I want you to be a part of it. But once again, just send us a request to send you a link at info@prudentmoney.com or at bob@prudentmoney.com. We'll get it to you. This is Bob Brooks. You got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.